Good morning. It's Jeffrey Christian of CPM Group. It's about 10:42 in the morning here in New York on Friday, the 15th of August. You can see from the list, I have a lot of things I want to cover, so let's just jump into it. Gold prices right now are trading around $3,340 in the spot market in London and in New York. We follow the nearby active futures contract, which is for gold, the December contract. It's $3,388, which shows a sizable contango or forward spread between between the inactive, very low trading in the August COMEX contract at this point, and the very active December contract, which has a lot of the charts hasn't been updated since the 7th of August. We've got people on vacation. Next week, they'll be back, and hopefully we'll get this updated and going. But you could see back in the 7th of August, which was, not quite a week ago or a little over a week ago, the price was over 3,400. And today it's down to 3,388 for the December contract. Not off too much. Silver prices are $37.95, 96 cents for the September contract. And it's off a little bit from a week ago, but we are moving toward the first delivery period of the September contract. We don't think that that is going to be a major issue pushing silver prices higher. But we do think there are other issues that could push silver prices higher over the next couple weeks. Again, we look at the political and economic environment primarily, as well as market developments within the markets. Platinum prices it's interesting, it's $1,354. That's probably about where it was, maybe a little bit higher than it was a week ago. It has come off and it has been trending lower, and we expect it to continue to trend lower. So too with palladium. Palladium, $1,137. That's exactly where it was when we did our video on Tuesday. And again, it seems to be trending lower, although we do have the upcoming September contract. Now, I want to spend most of my time on silver and silver surpluses and deficits again. We've been talking about this in several videos, and there have been questions and follow-ups, and I want to continue with that. There are other topics I'd like to talk about, for example, deficits and debt, etc., and what the government's need for cash and borrowing capacity will do to the overall economy. We also want to talk about gold, and platinum, and palladium, but let's stay on this for now. This one comment from, I guess, the Tuesday video was, thanks in advance. Could you help me understand why silver prices rise in a mining surplus and drop in a deficit? And again, it's not a mining surplus, it's a surplus. We'll go through that too. It's an excellent question, and it's a key to understanding why silver prices rise and fall, and the relationship between silver prices and mine production, and why investors who buy into a silver shortage and deficit myth get the market wrong and tend to lose money consistently in their investments. Right? First, do yourself a favor. Stop thinking in terms of a mining surplus. Mining surpluses are non-events, and we'll get back to that in a second. We really want to pay attention to total supply relative to fabrication demand. Surpluses are created when investors buy more silver and they drive the price higher. Deficits represent periods when investors are selling silver, adding supply on top of newly refined supply into the market, and that drives prices lower. And to understand that, first off, I highlight it here, titles that have always appeared in this chart whenever we use it, for only for about 40 or 50 years. Net changes in inventories represent the surpluses or the deficits. Surpluses are net additions to above ground refined inventories. They tend to represent investor buying. That was the case in the 1960s when the price of silver started the decade at $1.29 or so and rose to about $5 by the end of the decade. And then they sold and took profits over the course of the 70s. You had a deficit of investors selling into it. Net withdrawals, investors selling, that is a deficit. That continued until 1978. By 1979, we went back into a surplus. Investors were buying. They bought more than 200 million ounces of silver, driving the price to $50 for about 5 minutes in January of 1980. Over the course of the 80s, investors continued to buy. There were any number of investors who the price fell to like $16 within 3 months. And then it fell to $8 and $7. And by the end of the decade, it was down below $5.50 an ounce, on its way to $3.50. And during that period of time, you had any number of investors who said, hey, the price of silver rose to $50. It's going to go back. So in the initial years, 1981 through 1985, you saw investors buying a lot of silver, like, close to 100 million ounces in several years, in the expectation that $50 will be coming back. And I should point out there were certain people who were telling investors that there was a shortage, a fundamental shortage and deficit in the silver market, and the world was going to run out of mineable silver in the early 1980s. We've mined tens of billions of ounces since then. Investors kind of got disenchanted over the course of the 80s, and by 1990, they were net sellers. Not only did investors get disenchanted, you saw a number of banks and brokerage houses and trading companies and investment banks getting out of the gold and silver market at that point. And you had 15 years of deficits where investors were net sellers. Included in that was 1996, 1997, 1998, when Berkshire Hathaway bought 129 million ounces of silver. And you can see here, we have net selling in excess of 150 million ounces. That means if there was net selling of 150 million ounces, but just one entity was buying 130 million ounces, gross selling was even larger, right? By 2006, that changed. Investors were bidding the price up. They were buying silver again. The price had spent 15 years, basically between $3.50 and $5.50. The market was getting tight. You had a lot of marketing hype from brokerage houses and investment banks about the commodity super cycle and shortages. And the price of silver rose with a lot of other things. Peaked in 2011, came off 2012, 13, 14, moved sideways until 2019 and began rising again. And throughout that period of time, investors have been consistent net buyers of silver, keeping the price higher than it would have been otherwise. It didn't go back to $3.50 or $5.50. It didn't even go back to $10 once it got over 15. So that is the mechanics there. And that is the key to how it is that you can have lower mine production, larger deficits, and lower prices. Because if you understand the mechanics, and I'll get to it, again, I wanted to show you this. The relationship between fabrication demand and mine production is meaningless to the price of silver. The relationship of silver prices to mine production is very important. Silver prices are the independent variable. The dependent variable on silver prices is mining. Thinking about mining deficits is a bogus road for investors to lose money. Because you can see since 1960, and we had data going actually back to 1950, virtually every year there's a shortfall or a deficit of mining relative to fabrication demand, let alone investment demand. And that shortfall has been made up by secondary recovery, 250 million ounces a year, and sometimes by sales by governments. In the 1960s, a big chunk of that deficit, that shortfall, was made up by the U.S. Treasury selling silver that it had accumulated from the 1870s into the 1950s through various silver purchase acts and agreements. And by 1950, the market was getting tighter, and you started seeing electrification, increase in silverware and silver jewelry. Photography ceased to be a professional thing. It became much more readily available during World War II because it was used in the war effort, and then it became a consumer available thing. So you had an explosion of silver use in photography. And in that environment, it put upward pressure on the price of silver, which led the U.S. government to get out of the silver coinage business and the silver certificate business in the 1960s. But the relationship that counts is not mine production and fabrication demand. And the relationship is total supply of newly refined silver relative to fabrication demand. Now, why silver prices rise and fall? It's primarily investment demand. If you do econometric modeling on the silver price, as we have for 40 some odd years, what you find is that the major factors determining the silver price are investment demand and the economic and political developments that determine investment demand levels, primarily determine investment demand levels. Investors have total discretion to buy or sell silver or not even to be engaged in the silver market. They can just walk away, as they have, many of them, for a long time. Miners, refiners, industrial users, jewelers, financial service providers, they're involved in businesses that produce or use or trade silver. They have to be in the market. Investors can leave the market or enter at any time. They can enter as buyers. They can enter as sellers. They have much more influence as a group on the price of silver. And they have much more financial resources to put to silver than do commercial market participants. So when investors buy silver, they add it to above ground inventories of refined silver. They don't use it, they hold it. They hold it in refined form, readily available to be sold when they want to take profits or they get disillusioned. So the relationship between silver prices and mine production is that investment demand trends and levels determine the price of silver. Then the price of silver determines mine production, secondary recovery, and fabrication demand trends. That's really the way it is, right? So there you have it. It's not that silver prices rise in a period of large shortfalls of mine production or total refined production relative to fabrication demand. It's that mine production tends to fall when silver prices are low, right? So when silver prices have more influence on mine production than mine production has on silver prices. If investors are net sellers during a period of deficit, that leads to silver prices falling. That leads to fabrication demand rising because the price of silver and using silver in your products is lower. And it leads to lower mine production and secondary refining because of the lower prices. Again, silver prices are the independent variable in this equation. Mine production, scrap recovery, fabrication demand are dependent variables dependent on the silver price. And the silver price is primarily dependent on investment demand. Those are the mechanics of the silver market. Understand that, and you'll invest much better. Now, you don't have to believe me. I actually came across this video. It's about 12 and a half minutes long of David Morgan discussing silver deficits and the difference between CPM Group's research that shows surpluses and deficits and doesn't include bogus estimates of investment demand in that balance, to the data put out by the Silver Institute. And it's from 2018. So 7 years ago, 8 years ago. It's a issue that has been around really starting in the late 1990s. I did give a good interview to the Corlin Report, which should be posted on the Corlin Economic Reports website. It's a podcast. It should be posted tomorrow, Saturday, the 16th of August, in which we actually wound up getting into the silver market inter-corporate relationships that led to the creation of these bogus ways of adding investment demand to your fabrication demand for the specific and explicit purpose of presenting a more bullish silver supply-demand balance to investors by others. And that occurred in the second half of the 1990s. But David Morgan addressed this issue using both Silver Institute data and CPM Group data in November of 2018, and that's the link to it. So there. A few words on the economy. The U.S. Producer Price Index for July came out. It was higher than Wall Street and the government had hoped for. There were signs of tariffs showing up, but there were also signs of other economic strength, because today industrial production came out for July. It was up 1.4%, and it was strong across all sectors of the economy, even mining. Mining output increased 0.8%, but 1.4% was a very good showing strong economic activity. Business equipment was up 3.8%. That's really strong. That's the strongest growth that we've seen in companies buying equipment in many, many, many months. I didn't go back to see how long ago it was that we saw that kind of buying. And that's cool, because business equipment purchases is a leading indicator of future economic strength in other sectors. It suggests that companies are building new factories or modernizing their factories. That tends to be correspondent with consumers, or people being hired. People being hired means that they have money so that they can increase their consumer expenditures on both durable goods and non-durable goods and services. So business equipment rising 3.8% is a very strong indicator of future economic strength, perhaps delaying recessionary conditions. We also had retail sales in July released, and they were 0.5% higher than in June. That's basically in line with what market expectations had been. And again, it's relatively strong. Excluding automobile retail sales, retail spending increased 0.3%. So those two things sort of suggest that inflation, and you can see here a chart of the PPI month-to-month changes, spiking higher in July, and spiking higher than they've been for at least 12 months, all of which suggests that the Fed will continue to be cautious despite what Mr. Trump wants to extort from them. Anyway, let's look at the dollar, because people are still talking about the dollar collapsing. The dollar is off almost 7%. Actually, it's sprung up a little bit better. It's off 7% from where it was at the beginning of this year. It's up 9% from its low in 2021, and it's up 41% from its low in 2011. So the dollar is lower than it was a couple months ago, 6 months ago, 8 months ago. But you can see here, it's basically higher than it's been for most of the time since 2022. Dollar's not collapsing. Now, piece of trivia. Bad Robot asks, well, he's curious about some of this stuff in the back. It's not a photo, it's not a watercolor, it's an artist's proof, whatever that is, and it's called Evening in Brittany. It was a picture that was in my office at J. Aaron and Company, and I really liked it. When we merged into Goldman Sachs and Goldman built what was then its new office building at 85 Broad Street, um, they told me that they didn't want that picture to come across. I really liked the picture. It didn't have the water stain on it at the time. I really liked the picture, so I kept it. And they said, yeah, just take it. We're leaving it in this building as we vacate unless you want it. So I took it, and I've kept it all these years. The water stain came in, I think, probably 1986 after we left Goldman Sachs. I initially took some space at 111 Broadway on the top floor. That's the office building that next to Trinity Church. It's called the Trinity Building. And that's where Bernard Baruch had his office. And so I moved in there for the first couple of years of CPM Group. And I was on the top floor, and there was a leak, and it stained it. My wife actually came by the office a couple of days ago, looked at that and said, you really should get it re-matted. And since we have museum quality matters in the building where I work, I just have to go down one floor. There are a lot of chemistry objects back there. When I was in junior high school and into high school, I was a chemistry geek. And I was actually, by the time I was 13, they say that I was probably the youngest research associate at the Smithsonian Institute. And that came about through a couple of things that I was doing in my home lab. And I had some questions, so I wrote to a chemist at the Smithsonian. And then I also started working as an associate for the Smithsonian's Center for Short-Lived Phenomena that was being created, I think, in 1967, 1968. But I was a chemistry geek, and I still have this equipment. I'm actually, I have a whole lot of chemistry labware at home, and I'm trying to find a way to sell it to somebody because I don't get involved too much in chemistry at all. I did have this, you can see this very large 2,000 milliliter Florence flask. When I was in college, my roommate and I for a while would fill it up with Stolichnaya vodka. And when people came over, we had a distillery, we had my fractional distillery equipment set up next to the 2,000 milliliter Florence flask. And if they wanted a drink with vodka, we would pour it from there and sort of let them worry that we maybe had distilled the vodka ourselves. What else is over there? There is a black Maltese falcon, a present from my wife one Christmas. The Maltese falcon, for you movie buffs, will know that it was supposedly gold with a black lacquer covering to mask its value. And it was, as Raymond Chandler had Humphrey Bogart say, the stuff that dreams were made of. And I have a 10-ounce statue of Indian god that was a present after I gave a speech in Mumbai many, many years ago. And I have to say, there is a beautiful hat that says "Do Good," which was a present from someone from the high school that I went to who watches these and said, well, if you're going to tell people to do good, Jeff, here's a hat to wear when you do it. So those are some of the things in the back. One last point, little weekend reading. A couple of weeks ago, there was an editorial in the Sunday opinion section of the New York Times, and it's called "Thinking is Becoming a Luxury Good." And there's a link to where you can find it. It was published online on the 28th of July, and then I believe it was the 2nd of August was the Sunday. It's very good, and it talks about the fact that average IQs and reading skills and thinking, cognitive thinking and rational thinking capacities overall are deteriorating. And a lot of people blame smartphones and online reading and stuff like that. I think that those are factors, but I think there's a lot of other factors in there too, including a deprecation of public education. But the very interesting editorial um, in which Mary Harrington, who's a journalist in England, basically talked about long form literacy, the ability to read and understand long, complex information, and how that is becoming, there are fewer and fewer people who seem to be able to do that, partly because of the short attention span that you have with all those zombies walking down the street reading their cell phone and stepping in front of buses. It leads to a small subset of society that can actually process important information and think coherent, logical, linear, deep thoughts, which is very problematic. And it's problematic for our political future as well as our social and financial futures as a people, as a country, and as a world. So it's a really interesting thing. And one of the things that she does is she does mention a couple books that you can read that go into greater detail on it. It's be worthwhile you finding it online and reading it. That's all I have for now. You can go to our website, buy our yearbooks, subscribe to our monthly precious metals advisory, send us a note at info@cpmgroup.com. In the meantime, have a good weekend. Be good to yourself, be good to your people around you, and try to do something good for the world. We'll talk to you next week.